Good afternoon, everybody. This is Jeanette Sims with Trade Thirsty, and we are rounding out today with Larry Gaines. Next on deck is John Seville, and they'll be our last two speakers in our final event of December 2015 Toast to Traders. Larry Gaines of Power Cycle Trading is our next speaker. Larry, you have 1 hour.
Okay, well, thanks very much, Jeanette, and having me here today. I'm really excited about it. So we got a great crowd. So let's get started. I'm going to talk about one of my favorite things, and that's options. So hopefully I'll have plenty of time to answer questions as well. So we're going to talk about selling options for income and hedging. And it's a 5-step plan. Step 1 is avoiding the #1 option trading mistake. 2, the most important option factor. 3, how option pricing works. 4, knowing and using the market maker secret. And 5, highest probability option strategies for every market. So the following webinar is purely for educational purposes. Any stocks, futures, options, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So, basically I've been trading for over 30 years and was previously executive vice president for one of the largest oil trading companies in the world, Trans World Oil, and ran their international trading desk for over 10 years out of Bermuda. So it was a fantastic living experience and just a beautiful place to live, but it's also a great educational experience for me. So we were pretty much involved in all the different markets. Our big thing was crude oil and the energy markets, and so that's where I pretty much cut my teeth. But then we went on to trade all the other markets for liquidity, and got into all the derivative futures markets and forex, and started trading options with this group back in the mid-'80s. So we were one of the first actual trading companies to start trading over-the-counter options on crude oil, and that's kind of where I got my passion and interest in options. Went on to launch the institutional over-the-counter crude oil option brokerage desk for PVM London, which is the largest privately owned oil brokerage company in the world, and that was just another really fantastic learning experience for me there as well, just learning more and more about option structures and the various ways to use them. So, today I'd like to kind of first off start, by saying that trading for yourself can be just, super rewarding job, but it also can be very painful and stressful, which probably everybody here can attest to. So you really have to stay educated about what you're trading and stay very focused on managing your trading risk. And in times like this, we've had such a volatile past couple of months that it really comes in very, very important to understand the market risk. And for me, one of my kind of real trading aha moments actually came when I started to incorporate more selling type option strategies into my trading for both profit and for hedging. So if you think about it, options were created for hedging, as a hedging mechanism, and a lot of times that gets overlooked. So we're going to talk about all the benefits that you can get, some of the main benefits anyway, from selling options. But step 1 is avoiding the option trading, the #1 option trading mistake. Now, option trading has so many more advantages than trading stocks, but as you probably know, it can be a bit more complicated as well. And for the individual trader, options can be a little intimidating too. So that's why many investors will trade options by purchasing out-of-the-money options, often short-term options, since they cost a lot less, and a lot less than the longer-term options. And it's basically a simple strategy. So, for example, out-of-the-money calls or out-of-the-money options in general are popular because you can get them for very cheap. And it seems to follow the old Warren Buffett paradigm that we've all kind of grown up with, and that's buy low, sell high. But is this always the best strategy? So imagine you're bullish on Facebook and it's trading at $100. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike price of $120 that would be at a cost of 15 cents or $15 per option contract. Now, why would you do this? Well, because when you look at the math, you can do a lot of them. So if you were to purchase 100 shares of Facebook at $100, that would cost you $10,000. But you could take that same $10,000 and you could end up buying 666 contracts of the 120 calls and control over 66,000 shares. So, you look at that as just it's mind-boggling and eye-popping when you can look at that kind of leverage. So then you imagine Facebook, what if it went to $121 within the next 30 days, and then those 120 calls are trading at $1.05 or $105 per option contract just prior to expiration. Well, you do the math on that, and you can see you can make over $59,000 in 1 month, and that's just, seems too good to be true. So it's just incredible. Now, at first glance, this kind of leverage is awesome, but you don't want to let this, glitter fool you, because not losing money is just as important as making money. Now, the one problem with short-term out-of-the-money calls is that you have to be right about the direction the stock moves, but you also have to be right about the timing, and that really ratchets up the degree of difficulty. So to make a profit, the stock doesn't just need to go past the strike price, but it also has to do it within a defined period of time. In the case of the 120 calls on Facebook, you need that stock to reach 120 within 30 days to make a profit. So it's this dual objective of having to be right on direction plus on timing, which it really lessens the probability of an option trade being a winning trade when you're just always focused on buying options. And everything that I teach my clients is based on managing risk and increasing the probability of your winning trades. Now, in the Facebook option trade, you're wanting that stock to move more than 20% in less than a month. And this would be like a 2 standard deviation move. Now, how many stocks are likely to do that? Well, we'll see the odd few, that will go crazy, like the Amazons and Teslas from time to time, but really not many. So in all probability, the stock would not reach that strike price, and the options would expire completely worthless. So based on probability, and we can measure theoretically probability using standard deviation, there's only about a 5% chance for this stock reaching $120 to $121 by its expiration. So in order to make money on these out-of-the-money type of options or out-of-the-money calls in this example, you need to outwit the market or get plain lucky. And we used to always kid around that on the trading room that there was an old blues song, and one of the lines in it was that if I had no bad luck, I'd have no luck at all. So that kind of pretty much summarizes trading a lot of times. So again, then, being close means no cigar. So imagine now that Facebook, rose to 120 during the 30 days of your option lifetime. Well, you could be, pat yourself on the back because you're right on the direction the stock moved, but since you're wrong about how far it would go within a specific time frame, you'd still lose your entire investment, and that's always going to be outright painful to do. So based on this example, a better goal, in my opinion, for every trader would be to select trades based on what provides the most consistent positive returns and not a one-time big winner. And consistency is derived from making high probability trades based on reliable data and facts. Now, where there's a big disadvantage, such as the one you saw in this option buying scenario, you can usually just, flip that side of the coin and see an equal and opposite advantage. So in the case of being a seller of options, this gives you a huge advantage over being a buyer. Now, all the pro and professional, traders, they know this and they take advantage of it, and so can you. So as a seller, all the things in this example are the same, but in your favor instead of against you. So this is why a lot of people like to take advantage of selling options for both income generation and hedging. Now, by selling options, you're in essence selling time, and that's a pretty powerful dynamic. Now, it's a strategy that's yours for the taking if you understand, what to do. And you can also look at an option that's kind of like a coupon, that you have to be redeemed by expiration date, or else it's no longer valid. But how's this done and what's involved? Step 2 is the most important option factor, and that is the for income generation and also for hedging. It's the understanding and the concept of time, and that's kind of simple when you looked at that prior example. Now, there's one more thing I'd like to throw out there. If you've not seen it, you can do like a Google search on YouTube and just look for the interview that was done by Tasty Trade with Karen the Super Trader. So it's a really great interview that they did with her, and this is a lady that started trading options. She spent a lot of money learning about just buying options and the typical things there, and ended up usually losing all the time. So she just kind of, that light switch went on for her. She flipped it on, and she realized that, okay, well, if I keep consistently losing money, then what about the people that are selling? And so anyway, she created her own strategies for just basically selling premium, and now she's managing a couple $100 million of other people's money plus herself, just basically selling premium and doing these types of strategies. So take a minute when you have time and check out that interview. It's pretty cool. Now the key to selling options is time value, and it's used in trading strategies that take advantage of the accelerated time decay of an option into its expiration. And option income strategies, they're very tied to the time value and the impact that it has on the price of the option. So time value is also what we call the extrinsic value of an option. It's the premium that a rational investor would pay over its current exercise value, called the intrinsic value, based on its potential to increase in value before expiring. And this probability is always going to be greater than zero, thus an option is always going to be worth more than its current exercise value. So I want to show you a chart here, and just so you can follow the chart and see how predictable and powerful this option paradigm is, and then just answer a question about it. So if you take a look at this chart, and if you were to, this is your typical time progression for an option. So when you start, 120 to 90 days out, you're going to have very, very small time decay. So we can measure this on our option platform using what we call theta. Now this starts out very, very small, and then when you get towards the end of the life of an option, 30 days out, weekly options, it accelerates. It's kind of like, I call it time decay on steroids, and before you know it, you're at zero. So just think, if you were to, whatever security you're trading, if it was just to go sideways and not move at all, the question is, would you have rather bought this particular option, or would you have preferred to have sold it? So think about that, and then just, if you'd rather sell it, if it's going nowhere, turning nowhere, or buy it, just put in a yes for selling, and or no for, if you don't think so. So yeah, so seeing lots of yeses. So if that security was to go sideways, having no directional trend, you would have wanted to have sold those options 120 to 90 days out versus buying it. And this is the common natural time value progression for all options, and it's seriously like falling off a cliff blindfolded. If you're wandering around blindfolded, you're going to eventually probably stumble and make that huge mistake. Then step 3 then is to take that and then look at how option pricing works. Now the value of an option, the main components that value the option will be time value times the implied volatility times the intrinsic extrinsic. Now there are other variables in there, you've got the gamma and you've got vega and stuff like that that will influence price, but the main components will be these components here. And once you know these variables, then you're going to be ready to price an option and know which option premiums, what should be and what option strategies that you should use. So here's a table to kind of illustrate time value even further. So this is a table to show you on each Thursday you'll have a new weekly option series that comes out. And so when that first day, it's going to have 100% time in that option. So if you take time value times the implied volatility times the intrinsic extrinsic, that's going to give you the premium of the option. So in this example, kept this constant, the intrinsic extrinsic, and just changed the implied volatility so you can see the effect that it has on the price. So day 1, Thursday, time value, you've got full value in there times the implied volatility 300, gives you a price of $300. Now if you come in Monday, you'll see that that time value part of the option premium is cut in half. So then even if you raise the implied volatility, if it spikes up to say 800 here, it still barely pushes the price of your option premium much higher. And before you know it, on Friday, you're at zero. So you can see that if you're constantly just looking at the buy side only and not taking into consideration the time value and time decay, it's like you're swimming against a major current that's going out if you're constantly buying it and not aware of that. So then step 4 comes down to the market maker's secret. And it's really kind of what they don't want you to know, because they can make a lot of money off of you just from this one particular market secret that they don't want you to know about. Now, if you look at a broad market, you'll see that they tend to have, cycles where they'll go, up or down 2, 3 weeks maybe, and then all of a sudden you're going to see a sideways price channel where they're just kind of trying to catch their energy and kind of regroup, and you'll see price action just kind of going sideways. So they'll tend to go sideways, maybe 70-80% of the time. And it's based on this sideways price movement that the out-of-the-money option buyers will then probably, on a probability basis, lose approximately 70% of the time. Now, the market makers, they know these statistics, and therefore they're going to tend to trade from the sell side. And, this is the professional money, so you really need to understand what they're thinking and think like them. And then it becomes, down to, being based on the math of probabilities. So the market makers, they use their mathematical market probability statistics for pricing the movement of an option to its expiration. And by knowing the probability of the underlying security finishing within a certain range at expiration, this is key when you're determining what option to buy or sell and what option strategies you want to implement. So, it's a much more level playing field now if you understand these things, because, we all have our option platforms and we can get them pretty much free at a lot of the different brokerage companies. So if you understand the tools, then, you can start, looking at the market the same way as the market makers are. So these statistics, they forecast how likely it is that an option will fall within a certain price, up or down, by its expiration. And it's this statistical forecast, this is what we refer to as the implied move of the stock. Now, it's this implied move, this is a theoretical estimate of a plus or minus 1 standard deviation move of the underlying security by its expiration. So that's, a mouthful of explanation here, but when you look at, some examples here, it'll become more clear to you. So, based on these probability statistics, if you're selling options or option type spreads, when you're doing it correctly, it's going to provide the highest probability trade setups for generating consistent profits, and it's also a really great way for hedging risk. And it all comes down to the math and the probabilities. So in this example, this is a normal kind of distribution bell curve showing you distribution of price. So when you're pricing an option, it always starts at the money. That's where all supply and demand is. So this top of this curve is the at-the-money price of Google for this example, trade at $500. And then on your option platform, you're going to be given the implied move, and you're going to know how many days to expiration. So in this example, it's plus or minus 4% is the expected or implied move, days to expiration 10 days. So what this is saying is that if you take 4% off 500, that's going to give you a price of 480, and the plus 4% implied move to the upside would be 520. So this implied move is what we refer to also as the expected move, and it's from the 480, in this example 520. This is basically a 1 standard deviation move, which is a 68.2% probability. So this is great for price targets, to knowing what's realistic within the market based on what's given to you by the market makers. So in this case, what this tells you is that the realistic upside target is $520, and the downside target is $480 based on 10 days to expiration and expect to move a plus or minus 4%. So that is like a 68.2% probability that the price will be in this range. Now, for it to exceed that, either up or down, then the probability goes down. So you can see this curve, how it comes down here, the tail of this distribution curve. You can see down here, let's say these options are the 580 calls. Based on this distribution curve, it's only got maybe a 2% chance or probability to get the 580. So that's why you might see these options at 10 cents or something way out here, because it's telling you these are high risk trades. It's only got maybe a 10% or 2% probability of getting there. So by understanding these probabilities, it can help you determine what's a decent trade, what's a realistic trade, what's a good setup. So again, trading, if you think about it, is a business of probabilities. And to be successful, as a trader, to be consistent, you need to be focused on controlling your risk, and one important step is by knowing the winning probabilities of any trade that you're taking. And a really simple and free tool that you can use to measure probabilities is, one of the Greeks called the delta. And it's a really good tool because, number one, you can use it to, value the option based on the underlying move. But also the way I like to use it a lot is to use it as for a measurement or measuring the probability of price move based on the underlying itself. So here's a couple examples. So when you go on your option platform, you'll see delta, and if you see an option delta like a 68 or 70, you can also look at that and say that equates to the strike as having a 68 to 70% probability of being in the money at expiration. So an option delta then of plus or minus 16 is equivalent to that outside point here of 520 or 480, and it's also, telling you that that's about a 15.9% probability that it could be at 520 or 480. So it's a really good, quick way to look at the actual assessing a strike price or price and seeing if it's realistic, to see if it has a possibility to get to that particular point by expiration. So here's another example. This is, again, Google, and this will show you one standard deviation move where the implied move is going to be shown using this option analytics platform. So what I've done here is pulled up Google. So it was at that time trading at 582 was the at-the-money price. Days to expiration given to you right here, 22 days. The expected move over here, $34 up or down. Now, with your analytics, this is any option platform will give you this tool. You can set what we call price slices. So you can set standard deviation, you can set percentage moves. So in this particular case, I put a plus 1 standard deviation, minus 1 standard deviation, and then plug, this information was plugged in, and it calculates it for you. So the 1 standard deviation move was given at 622.28 to the upside, 542.80 to the downside. Now you could do this for each option example or trade that you're looking at, but it would take you a lot of time. So the easier, quicker way is just to go to your strike price, and then you can see down here if you go down to 620 right there, and you come over, follow that line over to your delta, that gives you an 18 delta, pretty close to that 622. We don't have a 622 strike, but it's close enough. So that tells me, okay, if I'm buying Google and it's trading at 582 and I go up to the 620 strikes, they might be really cheap, but then I look over here and I can say, oh, okay, I know why they're cheap now, because there's only an 18% chance that probably that price of Google at 582 will be at 620 by expiration. So it's a really good way to assess risk quickly and to help you to structure trade setups. So, using this analysis, it provides a trader or an investor a very useful tool to determine price targets to trade against, and it's also very useful for setting up your hedges. So, again, based on the math of probability, you can see that approximately 68.2% of options bought will expire worthless, and based on this, it's a really good idea to also consider selling options just as much as you would consider buying them. So you need to look at both sides of the market. And it's going to be this added option strategy for either profits or hedging. It can make a really dramatic and positive difference in your trading performance when you use it correctly. So this is, why the money, professional money uses it to take advantage of it, because they use it for profit generation, but they also use it for managing their risk. Now, step 5 then is, then select what is the right income option strategy for you. And the goal of every trader should be to select trades that are based on what provides you the most consistent positive returns, and not always that big home run. And one of the best ways to do this is by knowing which strategies are out there for income type generation, and then assessing which one is best for you, because everybody here today will have a different amount of capital that you can trade. You'll have a different amount of risk that you're willing to take, times of day that you can trade, etc. So you're going to have to pick something that suits you and your lifestyle. So the basic income strategies that you can select and choose from will be the covered calls, there's the calendar spreads, diagonal spreads, long iron condors, and credit spreads. Now these are all really good income type generating strategies, but some are better for certain market conditions than others. Now, a covered call, for example, you may have done those, and the problem with the covered call is it's a great strategy if the market's kind of consistently moving up, if you're doing a long covered call type strategy. But what happens when the market crashes down? All of a sudden your trades are turned upside down, so it stops working. So you have to look at these various strategies for the different conditions of the market. Now for me, my favorite income type option strategy is the credit spread, and basically for 4 reasons. 1, it can work regardless of market direction. 2, it can almost always work even if you're wrong, which is pretty cool. 3, the probability of profit is over 68% even without adding any kind of technical analysis, which then increases your probability even more. And the 4th thing, it's the perfect thing for hedging. So there are 3 types of credit spreads. You've got the bear call credit spread, bull put credit spread, and the long iron condor. Now the bear call credit spread is best if you think the market's probably going to go down. So it's a strategy where you're selling one call with a lower strike and then simultaneously buying another call with a higher strike in the same month. So instead of just selling naked calls and collecting premium, this is a way for you to buy insurance or hedge the potential downside risk by being wrong on just being naked short calls. Now here's an example. So if on this example, this is on the S&P 500, the SPX, which is the CBOE S&P 500. So this at the time was trading at 1988, and you can see here, I mean, this is what I call kind of open prairie up here. There's a lot of space until you get up to your trade setup. So here's selling the short call, buying the long call above it as your protection. So in this particular example, you're selling the 2045 call and you're buying the 2050 above it. So this is done as a spread. Now by doing it this way, you can collect the premium. So in this example, it collected $100 credit. That goes straight into your bank account. The difference in the spread, it's a $500 wide spread, 2045 from 2050, that's a $500 spread. You got $100 credit. So the balance, the difference, is your risk, capital at risk, $400. Now it's this $400, that's your margin. That's all you have to put up to do this trade, and that's the most that you can lose if this particular, in this example, the market went straight up through your green line through the spread. So you would lose $400. Now, this is without doing any kind of technical analysis, without doing any type of defensive measures. So, but you can see that you can make 100, but you're risking only 400, so you're capped. So that's if that ends up below your short strike, you keep the $100. That's a 25% return on your capital at risk. Now, the second type of credit spread is your bull put credit spread, and this is going to be used if you think the market's going to go up. It's a bullish strategy. So, question is, do I always use current weeklies? No, you can use these things with weeklies, monthlies, 5-year. You can go out years. I mean, you can use it at any time frame. You don't have to be set to one specific time frame. Now, the second strategy is this bull put credit spread. And this is basically a bullish strategy. So you're selling a put while simultaneously buying another put with a lower strike in the same month. So here's an example of this bull put credit spread, and this is on win. So it's trading, at $207 right here in this particular case. And so you could, if you're bullish on this, you think it's going to go up, so you could just buy the stock outright. You could buy calls outright. You could buy call debit spreads, a lot of different bullish strategies, or you could also sell a vertical bull put credit spread, and you can see the price is right here, but you're selling your put spread way down here below, quite a distance below. In this case, you're selling the 187 put short buying the 182 below it. So again, it's a $5 wide spread. You collected $130 credit, so that's your potential profit. The difference in the spread minus your credit received is 370. So if you did nothing at all to defend this trade and go straight down against you, you'd lose $370. Now, as long as it stays above this red line, your short strike at expiration, that 130 is yours, and that's a 35% return on your capital at risk, or your margin. That's what you put up. That's all you would put up on the trade. Now, the third credit type spread is known as the iron condor. So this is the long iron condor. It's basically just combining the bull put credit spread with that bear call credit spread. So you have these two spreads combined, so you kind of get that double credit, right? So you'd have your bear call credit spread here, your bull put credit spread here, and what you're looking for is price action. You just kind of go sideways like this, and you can leg these. So if it comes up here and rolls over, so your bear call credit spread comes down here, so your bull put credit spread. So you're doubling up on your credit received. Now, I don't usually do this strategy too much. I prefer just to either do a bear call credit spread or bull put credit spread because they're more directional. These types trades, they're a lot of times you'll have to do a lot more adjustments because of the price moving a lot, especially in a high volatility type market. Now, the thing I want to show you here, which is really going to open your eyes to this type of strategy as a complement to maybe what you're already doing, is to look at the risk versus reward on two. We're going to compare risk reward on two long directional option strategies. So they're both bullish strategies. And strategy one is just the old traditional, hey, let's go long by buying calls, okay? So we're bullish, we're just going to buy calls. Strategy two is still a bullish strategy, but it's a little bit more, less risk involved. It's going to be a higher probability, potential for profit. And this is selling the out-of-the-money bull put credit spread, so it gives you a higher probability of winning. But it's going to be less profit, but a higher probability of actually being a winning trade. Now, here's what it looks like if you do the two. You'll see how the risk can change if the market rolls over on you. So strategy one is when it's trading at $207, so you're going to buy the at-the-money $207 calls, and they were at $11.40. So one option is equivalent to 100 shares, so that'd be $1,140 for one option contract. So it's a great bullish strategy. If you think the market's going to go up and it goes up, this is where you make a ton of money because your upside potential is pretty much, unlimited. You're capping your risk at your premium paid at $1,140. So it's a great strategy as long as that market pushes up. Now, strategy two is a bullish strategy, but this is selling the out-of-the-money bull put credit spread, the 187, 182, and this spread, when it was put on, was sold below Wynn's prior low, which was 189, and it was at 9.5% below where Wynn was trading at this time at $207. So we're going to compare these two together to see which one did best or worse when the markets rolled over. So here's strategy one, and in this case, John, he was very bullish on Wynn. It was trading at $207, so he bought calls outright. So he paid $1,140 for an option on that call option, the 207 call. Now, when he on May the 8th, Wynn took a nosedive and rolled over. So, John opens up his P&L and he looks down at his open P&L. He's down $583 per option contract. So $583 per option contract. That's smart. So that's pretty hard to bear when you look at that. So that's what happens, when it rolls down. Now, on the 21st of May, Wynn pops back up a little bit, so it's trading at 205. So it's just $2 below where it was originally set at 207. So John opens up his P&L. He's down $518. So not much of an improvement, So it's a real bummer. Now, Jeanette, she would decide to do this trade a little differently, to kind of less risk by doing it as a bull put credit spread. So she, when it was trading right here at 207, she sold the out of the money bull put credit spread way down here. She sold the 187, 182 bull put credit spread. So it was below that prior low 189, and it was about 9% below where Win was trading at the time. So, if as long as it stays above that short strike at expiration, she'll keep the 130, and that would be a 35% return. Now, let's see what happens to this trade when the market doesn't go the way you want it to go. So here it is on May 8th. It drops down real hard, and it's trading down here, at 196, excuse me. She opens up her P&L, and she's only down $38.50, so not too bad. And John is down 583, so pretty rough deal, but you can at least manage through that one. Now on the 21st of May, it finally recuperates and comes back up a little bit, so it's trading at 205. So she opens up her P&L, and now she's actually making money. She's back up 78.50 per option contract, but John is still down 518. So that just shows you the difference between two bullish strategies, by using a different type of strategy, for the same kind of price action or same direction. So these are two different ways that you can look at, trading. Now, I call this the most forgiving trading strategy ever, and that's the credit spread. And here's another couple examples to go through. Now here's SPX, S&P 500, and this was back on November. The way I like to use these is kind of on a directional basis. So when the market's trending up, I look for the market to kind of stall and lose momentum, and so I use my indicators, and they start to stall out and go negative. So when it starts to stall and flatten out, then instead of maybe buying puts, because as we've seen so many times, the market will stall and then it'll just keep grinding up. So every time you're doing directional shorts, this year, sometimes it's been pretty hard, because those puts, if you're buying puts, that theta decay each and every day, if it's not crushing to the downside, will still make you lose money. So instead, I'll sell like close to 1 standard deviation out of the money. So up here, sold the 2140 calls short, bought the 2145 above it, that blue line, so you can see the short trade right up here. And so I'll do these, anywhere from 15 to 20 days out. You can do them 30 days out or more and get, bigger credit. But I like to do it. That's kind of the sweet spot for me, because, less than 30 days, that time decay really starts to kick in fast. So, again, it was trading at about 2130 right here. So sold, up here above 2140, 45. So I'll take you through this trade example to show you, what it looked like. So when the trade was put on, it was a $500 wide trade, because it was selling 2140, 45 bear call credit spread. So $500 wide spread, brought in $100 credit. The difference then is your capital at risk 400. That's your margin you put up. So this was not quite 1 standard deviation, but close to 1 standard deviation. I used like a 17 delta, like I showed you earlier, and I set that short strike at the 17 delta and then bought the strike over it. So this was put on the 4th, taken off the 13th, because the market just cratered to the downside, but kept at $100, and that's a 25% return on your capital at risk. So you could do 1 contract and make 100, or you could have done 10 and made 1,000. So that's the example of that out of the money bear call credit spread. And I also like to question, do you use Fibonacci levels to determine the credit spread? Absolutely. I use Fibonacci levels on every trade I do. I look at the Fibonacci levels to determine where I want to sell or buy something. So that's definitely the way to do it. Now, here's what it looks like when you look at it on the analytics chart. So here's selling the 2140 call right there, and your long call right here is your hedge. So if you're wrong and it goes up, you would lose $400. But if it stays below at expiration, below that 2140, you make the max profit. So in this situation, it closed below it, and that's the max profit of $100 per contract. So however many contracts you're trading, and that would be a 25% return on capital. Now the question always becomes, well, you keep doing these, you could just have one that would wipe out all your gains. Well, that's true, but remember when you're doing a credit spread, as soon as you go into a credit spread, if it's a 1 standard deviation out of the money, as soon as you put the trade on, you're roughly putting it on with a 68% probability of winning. That's without doing anything, without trying to defend it if it goes against you, and that's without technical analysis. So then if you add technical analysis, let's say you had a trading system that's, 60% winning trade setups, so instead of 50-50, you would increase it by 10 basis points, so that would increase that to 78% probability. Or if you had a trading system that was 78% winning model, it would increase it even more. So that's one way to increase it. The other is by defending. There are certain defensive techniques and strategies you can take if it goes against you too. So you're not going to, the key is you're not going to lose your $400. So the key is don't ever lose the full amount that's at risk. And that's, a big part of trading these credit spreads, but there are a lot of great defense strategies for that. Now here's another way to use it, the in-the-money bull put credit spread. And I like to use these. This was on CLR, an energy company that, this is a good one to short. If you're looking for energy companies, it's already had a big move down, but this is one to keep looking for shorting on any kind of retracement rallies because they have most of their productions in the Bakken, which is up in the mid-continent, so it's more expensive to produce and it's more expensive to get it to market because most of the stuff has to come by rail. But anyway, so this was breaking trend line. We were in what we call a volatility squeeze here, so looking for a trade breakdown, momentum cycle 1 and 2 are down. So I did a combination. I bought put spreads. I like to buy put spreads and call spreads, but I also sold the in-the-money bear call credit spread on this because the premiums were really good. So by doing this, it was trading at 33 at the time. This was on the 4th. Got out. Well, you can see where it was yesterday. We'll show you at expiration, but by doing this, it was $1 in the money. Sold. It was trading around 33 and sold the 32.33 bear call credit spread. So short the 32, long the 33, and it was 1-to-1. That's what I liked about it. 1-to-1 risk reward. Risk $1, make $1. So it was also, these are cheap. You can see the thing that's great about these options. A lot of them will have dollar wide spreads or sometimes even 50-cent wide spreads. So this was a dollar wide spread. So risking 50, received 50 credit. So 50-50, and by adding technical analysis, it broke down. My indicators were down. That increased my probability from, greater than 1-to-1. So just let the trade roll out, and it ended up, now it's down to 24, so it was max profit. So that 50 cents, was kept at expiration, and that was 100% return, $50 per contract, and you do as many contracts as you, can look at you want to do. Now, the other really cool way to do these things too is the butterfly premium collection strategy. So this was done yesterday. This was put on Thursday, and you'll see where it was taken off yesterday. And this is a premium collection kind of option expiration type strategy, but it's using the same concept of selling premium for volatility going to zero and time decay going to zero. So here's the trade setup just to show you another way to use these kind of credit spread combinations. So doing an option expiration, some analysis here on where the potential pinning could be based on the analysis came up with $105 on Facebook. So based on this analysis, then put together a butterfly spread, and these are unbelievable because their costs are so small, your capital at risk is tiny, but the return is huge. So here was the trade setup. This was done on a Thursday, and the way the structure was, it was selling the 105. Basically, it's two separate spreads, but when you combine it together, it creates the butterfly. So the first spread was selling the 105, 104 bull put credit spread, and then the second part's buying the 106, 105 debit spread. When you put those together, it creates the butterfly, and in this situation, it was a $10 debit. That's all it cost. So the most you could lose if you were totally wrong on this was just $10 for one option contract. But since you can see the spread, it's 106, 105, 105, 104, so it's a dollar wide spread, right? So the difference of your $100 wide spread minus your cost of $10, you've got a potential theoretical profit of $90. So that's huge. You know, that's a 900% potential return on the risk of just $10. And this was put on a Thursday and taken off yesterday. So one-day trade ended up making $39. That doesn't seem to be a lot of money, but when you look at it basis the risk you took of $10, that's still a 390% return on your capital at risk for one-day trade. So that's just another way, you know, to look at these, you know, kind of credit spreads and using it. And here's basically what this butterfly is. It's just basically a bull put credit spread here, selling the 105, buying the 104, and then it's a long debit, vertical debit spread on the put side. So, you know, did that at $10. You put those together, and that's how you manage it. But it's a great strategy for certain situations. And, you know, it went out, you know, here you can see the analytics here. That purple magenta line is actually where the price was going into the expiration. Now, if it pinned exactly at 105, that purple line would have been right up here, almost identical to the theoretical underline. Now, the other way I like to use these credit spreads is I call it offense defense, and this is an example on Apple. So again, you know, trading is risk management, and the key to consistent winning is having good risk management. So this is just to show you that, you know, not, you know, losing sometimes is going to always happen to us, right? So you want to try to, you know, create situations where you can limit your loss. So one of the best ways to do this is, you know, using this type of strategy. So here's the original trade was a long call debit spread on Apple, and then it started to, you know, not look too good. So the fence was set up to do what we call a broken wing ratio butterfly credit spread. Sounds like a lot, but you'll see how this works. So here was Apple, the original trade set up, and it was, you know, right here. It was on the 30th of November. It was breaking a trend line. It was looking really good. Momentum was up. So here's a shorter term time frame, 78 minutes. So everything was looking good, and then it just started stalling. So the first hedge was put on right here on the 2nd of December, and then also ended up adding another leg to it on the 9th. But this is how that trade ended up working out. So the first initial trade setup was just your typical debit spread, call spread. So it was buying the 119, 121 call spread. Very little capital at risk, $92, but still, you know, $92. And you know, it was a very tight spread. Had a potential, it was better than 1-to-1. Had a potential to make $108 and risk 92. So that was the initial trade. So it looked good based on technicals and everything. Now, the original trader's right here, debit spread of $92, 119, 121. But it started to roll over. So the first hedge was put on the 2nd of December. And this was putting on a bear call credit spread, and by also doing it as a what we call a skip strike or a broken wing, so it's not exactly symmetrical. So anyway, it's kind of hard to teach exactly in this one particular example, but you can see here the original trade is 119, 121 call spread, and then sold the 121, 124 bear call credit spread above it. So you can see this spread here is $2 wide. This spread here is 3. So by increasing the spread width, I was able to collect more credit right here. Now that credit then offsets my potential at risk of $92. That reduces it by $50 right there, that credit brought in. Now, it didn't look any better, so instead of just getting out of the trade, it's so easy to do this, I just sold another leg, the same credit spread. You can see right here, sold again, one more, the 21.24, collected $25. So my total credit received then was $75. So by doing that, I created this particular structure here. So this, my max loss then became $17. Potential max profit was if it pinned right here, the profit was a couple $100, and if it went down, I increased my risk here. But here's how that trade, the full makeup looked when you look at the analytics So going back through the trade setup, the original trade was 119, 121, $92. Hedge 1 was put on the second, selling at 121, 124, collected $50. Sold another same leg, 121, 124, collected another $25. So ended up reducing my contract potential downside exposure to just $17. And then it gives you time to trade in and out if you want. Well, I just let it go and I lost 17 bucks, but the potential would have been 92, and you could have done some other things. But I like to do it this way because if you're managing a lot of trades, it's an easy way to structure these type of hedges, so then you can come back to them at another date and time. You don't have to constantly be looking at it each and every day, worried about the trade. So a lot of different ways to get out, but this is the beauty of it. And this also, if it had pinned at 121, this had a potential to make a couple $100 on that type of setup. So really great way to do it. Here's one more that I'll show you. This was on Lululemon, kind of the same deal. Long a call debit spread, but then ended up doing a bear call credit spreads to hedge it. So I'll go through this kind of quickly. But the trade was, looking good to the upside, volatility squeeze breakout, and then it started rolling over. So decided needed to put on a hedge, but I wanted to stay with the trade because it had potential coming into earnings to pop back up. So the original trade was putting on the 67.5 long call debit spread, 120, maxed at risk. Started to roll over, so hedged on the 20th, sold a 72.5, 75 credit spread, got in 38 bucks, but did that 2 times. So it's a ratio credit spread, so 2 times the credit spread for every one long. By doing that, increased the amount of credit could bring in at $76. So reduced my downside risk from a 120 less the total credit to $44 per contract. Now Lululemon, did crater, went down 13%. If I just stayed long that call debit spread, it would be down. It would have been against me at $80. But on that next day, on the 25th, bought back that spread, the credit side of it, for it cost me $18 to close it out. So based on that closing it out, had put it on at 76, closed it out at 18. So that's an adjustment. I made $58 on that side of it. I take that off the original debit spread of 120. So now the adjusted price went from 120 to $62 per contract. Lululemon jumped back up to 128. Took profit at 128. I mean, it popped back up, and the original debit spread went to 128, less the adjusted cost of 62. That ended up being a $66 or $106 per contract return on capital. Well, a lot of trading and a lot of these spreads, you think there's a lot of commission, but if you do, it depends on your trading. I will pay an extra commission if I can, hedge my positions like this, where I can do it quickly. So you can do these type of hedges really fast, and it's just the cost of your business. It's just, do you want to do trades that are just, you can limit your commissions by not doing a spread, but you make a lot more money, but your downside risk can be a lot more? Or do you want to do spreads where you have a little bit more business cost or cost of capital in there because your commissions are, that's the other side of the coin. For me, I've always liked doing spreads because it just reduces my risk, and it also reduces my stress. So, those are considerations for you to look at. So this is, basically a lot of different ways to look at markets. You can either, just the old Warren Buffett, go long. Let's go long calls, or let's go long the stock. Or you can do these other type of strategies, or combine it with what you're currently doing just to reduce your risk. So if you're trading, depends on your amount of capital you trade, maybe how many positions you do. But if you're trying to manage more than 1 or 2 positions, some of these types of strategies to complement what you're doing is such a benefit. So, just wanted to open your eyes to see the various ways to do these things, and hopefully this will give you some interesting perspective for 2016. So, seeing some good questions here. Now let me get to those, but before I get into all the questions, take a few minutes, and I'd like to share a few client feedback stuff from various clients. I think it'd be worth your while. So it's always, super rewarding to get some good feedback from your clients to know that you're helping out. So I just wanted to share this with you. Now, the next thing I wanted to talk about is some other things you can start doing now to start helping you generate a more steady stream of income each and every month for yourself going forward in 2016. So wanted to go into a little bit more detail on this type of trading. So what I put together for this special event today is a super fantastic offer. It's a holiday offer. It's also just for my friends here, Jeanette and Hubert, for inviting me. So it's a 4-for-1 special bonus package. For the first 30 that sign up here today, I'm going to give you a really great educational package, and it's only $97 plus a money-back guarantee. So let me show you what you're going to get here. So first off, I kind of touched on the credit spreads, but this is going to be a 5-hour on-demand course that you'll get just 100% on credit spreads, a step-by-step course on using credit spreads, how to set them up, defend them, etc. You're going to get my 13 option strategy diagram along with this package. Now, the other thing, though, you're going to get is my butterfly course, which is, if you've never used a butterfly, you're going to get exposure on how to use butterflies. It's called High Reward, Low Risk Option Butterfly Course. You could see from that trade earlier, risk $10 to make potentially 90. But this is a course I did about a month and a half ago. It's a 4-hour course, so you'll get this as a bonus on demand. You'll get all the PowerPoints for both courses. My courses are very detailed. Now, if you go to my website after the fact and want to buy these courses, it's $197 for this credit spread course, which is a great course in general, period. But also the butterfly course, you can get that for $197. But today you're going to get everything, both courses for $97. Plus you're going to get a follow-up live Q&A. So after you've taken the course, gone through it, we'll do this in a few weeks. You can come in to this live Q&A, ask questions about it. We'll go through trading examples. And then the last bonus, I'm going to give you a free month to my trading club. So everything here just for $97, and if it's something that you don't like or you don't, it doesn't work for you, 100% money satisfaction guarantee. Just send me an email, and we'll send you your $97 back. So if you've never traded an option, if you've never traded a credit spread, butterfly, etc., this gives you a great entry into this type of trading. So the link, let me give that to you here real quick. Let me get that for you. So it's powercycletrading.com/TOP. Use small caps here, top. And the courses are on demand, so you can watch it anytime you want, over and over and over. It's yours for, forever. And you'll be given a link and, login information, so it's on the cloud so you can access it from any place. And then you'll be given the PowerPoint, so you can print those out. I'm a paper guy, so I like to put notes down and stuff, so you can do that. So here it is, and I like to keep these groups small enough to be able to make sure I can answer your questions during the live Q&A. So in the credit spread course, this course goes through how to use credit spreads to create these low-risk, kind of high-probability trades. And then how to use credit spreads, on stocks and index options. I like to do these in certain situations on the index options like SPX and NDX, RUT. When to use the deep in the money, why to use the steep in the money and when to use those. How to use these type of strategies to consistently grow. You can take a small account. You can see how very little capital that you have to commit or put up. And so you can take, consistently take a small account and start making it to a bigger account with very low risk. And then the big thing that's taught in the course that's wasn't mentioned today really in the webinar because this is a big part of the course, is how to defend these particular types of trades. So I'll give you 6 defensive strategies for different market conditions, so you can defend these trades super fast. If it starts going against you, you don't have to think, oh, what am I going to do? You're not panicking. These are specific defenses that are so easy to put on, and so I teach that in the course. That's a big part of it. And then when to use the iron condor and when not to. It's not something, like I said earlier, that I use that much, but I go into detail when I do use it. And it's also adding the credit spreads to your trading. It's great for position sizing to diversify your risk. So go through in the course how to actually do that. And then it's fantastic because if you look at an out of the money kind of credit spread, when you go into it, you have a 68.2% probability. If you add some technical indicators and things like that, you can see how you can potentially turn it into a higher probability type trade. So go through examples and details there, step-by-step guide for executing the spread, technical analysis, what I like to use there, best market time frames for the spread, when to put them on, how far out to go, week, 2 weeks, 3 weeks, when to take them off, go through the various structures there. And then how to do it, end of the day, so you don't have to be glued to your screen each and every day, going bug-eyed. So I like to do the trades. I don't like to be watching my screen all day long, so I show you, when to do them, how I do them towards the end of the day. So a lot of great information. Then the second bonus course I'm throwing in is the option butterfly course. It is a great strategy for certain market situations. In this course, we go just the Greeks that are needed, theta decay, its impact on the butterfly, volatility, its impact on the butterfly, and then, what is the butterfly? What really makes it work? So we go through the foundation of what is the actual butterfly, and then teach you in this course the butterfly spread, using it for monthly option expiration, which is a really great strategy. And one of the great strategies with the butterfly is what we call the butterfly spread defense. This is a way to defend a vertical spread, either credit spread or debit spread. This right here, this is worth the price of the course. If you do a lot of just call spreads, vertical debit spreads, or put spreads, this is the quickest way to defend a trade that goes against you, by using this butterfly defense. And then a really great one is that butterfly, the broken wing. I showed you kind of one example there. And then the iron butterfly, and then basically how you can turn 10 into 190. And that situation on Facebook was 9 to 1. So of course here, just for your a bonus there for just being here today, and also get 1 free month for my trading room. So you can check this out, kick the tires, and you can cancel this at any time. But I've got a virtual trading room that's open each day. Open it up at 9 a.m. Eastern, and I'm in there every morning and afternoon, going through the trade setups that we're doing, swing trades or day trades. I do daily video updates every day, so you'll see all those. You'll get that report every night. Nightly video alerts, and this will show potential breakouts and trend reversals. And I'm really big into also trading seasonality. So in these videos, go through whatever the seasonality is currently looking at, the various trades there. And then every week we do a Q&A, and you get reward points, discounts to everything that I do. So all that with a money-back guarantee. So if you're looking for a way to get started, some different strategies to look at, kick the tires, here's a great opportunity for you guys going into the new year, guys and gals. So just put in powercycletrading.com/TOP. Okay, so you're not going to see, when you pull up the link here, these are bonuses for the first 30. So when you pull up a link, let's pull up, and if you have trouble with a browser, just change to a different browser. But this is Google Chrome. So I just put that in. So when you pull up this order form, all you're going to see is trading credit spreads for income, $97. And you're not going to see the bonuses because the bonuses, are not included except for the first 30 that sign up. So that's why you're not seeing the trading. You're not seeing your 1 month trial. You're not going to see the butterfly course, and you're not even seeing the follow-up Q&A. So these are all bonuses for the first 30. So once I get there, then I like to stop because I like to make sure that the Q&As are small enough to make sure I can answer all your questions. Question here, let's go through some questions. Yeah, so it's powercycletrading.com/top. So you should have that there. So if you're not able to get into it, Al, again, change your browser. Sometimes, I don't know, for whatever reason, some browsers are difficult. So I always have trouble with Internet Explorer. So either go to Firefox or Google Chrome, try that out. Let's see, make sure you're using small cap. I see that you're using large cap here, so it won't take it with large cap. That's why I see you're using large cap. So use small cap and I think you'll be fine. Firefox works, Google Chrome works. All right, I tell you what, I'm actually over 30, but what I'll do here, since there's a lot of great interest and some of you are having trouble, I'll just leave this offer open for the rest of the day. So if you're, so you don't have to, be scurrying around everything. So since this is a special event for me and for my friends there with Hubert and Jeanette, I'll just leave this offer open for the rest of the day. So if you'd like to take advantage of it, we'll just leave it open. So that'll make it easier for you. So again, this is all available, powercycletrading.com/top, and here are all the bonuses. So just look forward to working with everybody here, and just like to say thanks for being here. Let me see if I've got some questions here that I can get to. So the question is, can you use an iron butterfly for earnings trades? Yes. There are different ways to use the iron butterfly now. That's what we use for like a volatility, selling volatility, is the iron butterfly. So it is a great strategy for looking for volatility collapse. I like to do those particular trades for earnings on the day of an earnings release. That's usually the way I do it for an earnings trade on a release date. If I think that, well, volatility always collapses after an earnings, but sometimes you'll get a bigger move than the expected move, so that's one thing you have to take into consideration. So I'm just going through these questions. They start scrolling to the upside. It's hard to follow them sometimes. Scrolling down to see what else was in here. You should be able to do these credit spreads in your IRA, so just check your broker. If they're not allowing it, you might want to look to change to a different brokerage account. Now with commissions, various different brokers have better commission rates too, so that's something else for you to look at, to see what the commission rates are. And, again, these are different, options were created for hedging. So it's not something like you have to do all these different option spreads for every trade you do, but I'm just showing you, I wanted to give you an idea how you can hedge a position quickly, so you don't have to be thinking, oh, what should I do, what should I do? You need to be, as a trader, every time you take a trade, you need to have an exit plan. So what is your plan if you have the trade go against you? So in this course, I teach you some defensive strategies that you can use, for immediately putting on a hedge that can reduce, a lot of times, can cut your potential at risk in half and even more. And when you're trading and you're trying to make quick decisions, are you thinking about how much your commissions are? Or are you just thinking about controlling your risk? So I want to ask a question here. So when you're trading, are you looking at your commissions on every trade before you do the trade? So before you put the trade on, you're probably looking at commission. But what if the market starts going crazy against you? Are you thinking about your commissions, or are you just thinking about the risk? If you're thinking about commissions or risk, if you're just thinking about commissions, put yes. So, when the markets are going crazy with volatility and you're needing to take quick decisions, I'm not really thinking about commissions. I'm thinking about what is my, how am I going to manage my risk? So, question is, what is my take on the S&P for Monday? That's a great question. Well, let's take a look. I am a big proponent of seasonality, and right now the markets, based on seasonality, the markets should push up next week. But that's not going to every year. Seasonality sometimes doesn't happen. So right now the technicals don't look that great. So if you look at just from the daily standpoint, from a swing low to swing high, we're about a 50% retracement coming in here. So if it's going to bounce, this would be a good area to bounce from. Okay, so that's one thing. So you can see this swing low right here. Now, if you look at a weekly, same situation right here, the 50% retracement, and then further down. Now, if you look at a monthly time frame, let me pull up to maximize chart. So the other thing too is if you look at the monthly time frame, we're pulling back into this 21 period moving average. This is what I like to look at for kind of a longer term trend, kind of support levels. So if Monday comes in and it comes down here to 19, let's say 75, I'm going to be looking to buy the market for a retracement bounce off that major moving average there. So that's one thing I'll be looking at. So I think that if we do get a fall through sell on Monday, it'll be a short. It'll be bought, and you can see here that the Nasdaq is even stronger. It's coming into only the 8 EMA, very strong uptrend still. And the other thing about the markets are that we have a lot of seasonality that kicks in, the Santa Claus rally. So, that's a pretty strong seasonal effect. So a lot of people will be looking at that. So you could easily get down here next week on the open to 44.51, but I think it'll probably bounce off of that level. And then the other thing is to keep your eye on the big, those FANG guys, Amazon, Google, and see what they're going to do. So if you see the buying coming in for Amazon, Google, you're going to see the markets stabilize. And then the other wild card will be crude oil. Now, crude oil and gasoline also, I know crude has been just destroyed, but when you look at gasoline, it has a really big seasonal effect where it starts going up this time of year. So we're buying gasoline cracks, buying gasoline, selling crude, buying gasoline, selling heat. But look at the pattern here for gasoline. It's holding, consolidating here. Momentum starting to shift to the upside, and then you look at crude oil. I mean, it's still hurting bad, but it's down. But gasoline is starting to consolidate. So these are a couple things I like to look at. So I think crude oil will probably head down here, probably test that prior low, which was 33.20. But I like gasoline. And bonds look like they're going to potentially break to the upside. 30-year tight squeeze, looks like it's going to probably charge higher. So TLT, long TLT, I tell you another good trade setup if you can get in right is long TLT, short HYG. Yeah, so here's that link again. Everybody should have it. There you go. Yeah, so BBRY, sure, I'll pull up BBRY. Wow, that looks good. Well, that looks real good. I'm going to write that one down. Thanks. That looks good. I like the looks of that. Breaking back over the 200-day moving average. Momentum, very powerful. So you had earnings that were obviously pretty good. Oh, wow, that looks great. You're in a weekly squeeze. This looks really good. Looks, you know, and it's breaking that 50 simple. Target 9. Oh, this is a cheap stock, $9. Wow, that looks pretty interesting.
Hey, Larry,
No,
if you
you
go
want
ahead
you
and
want to
take
see the
maybe one more
bonuses?
question and then wrap
Okay.
up.
Hey, thanks very much, Jeanette. Sorry it took so long here.
That's okay. We've got Johnny's waiting, so I just wanted to maybe give you a couple more minutes and then we'll pass the ball to him.
Thanks. Appreciate it. Good luck, everybody. Look forward to working with everybody in the future. Thanks.
All right, everybody, just give me 2 seconds here, and if you have questions for Larry, you can send us an email to help@tradethirsty.com, and we'll make sure that those go straight to Larry. I don't know if he shared his email address. His personal email address, I think, is larry@powercycletrading.com. So give me 1 second. All right, so there is Larry. Give me just a